What's up, everybody? According to Zillow's 2024 housing market report, the U.S. housing market is finally starting to cool off. Home listings are piling up as buyers step back from peak home shopping season faster than normal. Zillow's chief economist, Skylar Olson, wrote in the report, as competition cools, sellers are stepping up price cuts to try and entice buyers struggling with affordability. In Redfin's latest housing market update for the 4 weeks ending July 14th, 6.7% of the homes did have a price drop, up 1.8 points from a year ago and the highest level on record. Olson continued, a housing market that for years has been defined by fast sales and few options is starting to look more like it did before the pandemic in terms of competition among buyers and their negotiating power, if not costs. Now, we all know that real estate is very localized, but nationally it does seem like the housing market is softening. Yet, it is still completely unaffordable. According to Morgan Stanley, most homeowners are not experiencing the decline in affordability because they have fixed mortgages with super low interest rates and are holding onto their homes. In other words, U.S. homeowners are the strong hands this cycle. In finance, the term strong hands refers to investors or market participants who have the financial capacity and confidence to hold on to an asset for a long period. Rapidly deteriorating affordability in this cycle has already caused significant decreases in housing activity, specifically existing home sales, but has left national home prices more or less unscathed. As we have detailed in numerous research reports, the biggest reason is the lock-in effect. Homeowners have not experienced a decline in affordability. They have locked in low fixed-rate mortgages for 30 years that have simply disincentivized them from listing their homes for sale, wrote Morgan Stanley analysts. In other words, homeowners represent strong hands in this cycle. So today, we'll take a look at Zillow's latest housing market report, Redfin's latest housing market report, and Lance Lambert's article for Resi Club titled, Morgan Stanley argues that U.S. homeowners are the strong hands this cycle, and break it all down. So let's dive right in. Morgan Stanley's argument is that because homeowners are this cycle's strong hands, there will be a lack of homeowner distress and few distressed sales. In Adams' mid-year 2024 U.S. foreclosure market report, there were a total of 177,431 U.S. properties with foreclosure filings, default notices, scheduled auctions, or bank repossessions in the first 6 months of 2024. That figure is down 4.4% from this period a year ago, but is up 7.8% from this period 2 years ago. In contrast to the first half of 2023, foreclosure activity across the United States experienced a decline in the first half of 2024, stated Rob Barber, CEO for Adam. In addition, U.S. foreclosure starts also decreased by 3% in the first 6 months of 2024. These shifts could suggest a potential stabilization in the housing market. However, monitoring these evolving patterns remains crucial to understanding the full impact on the real estate sector. The absence of distressed sales and foreclosures could be the main reason why national home prices have remained stable despite mortgage rates doubling over the past few years, according to Morgan Stanley analysts. Zillow's June 2024 housing market report shows home price appreciation is up 3.2% nationally, down from a 2024 peak in March of 4.6%. Monthly gross has decelerated to 0.6%, the slowest June appreciation since 2011. So while home prices are still going up, the slower home value growth could give struggling buyers a chance to catch up. Zillow forecasts home values to rise only 1% nationally through June of 2025. In fact, while sellers still have a slight edge nationally, Zillow's market heat index shows a balanced market may be just over the horizon. We all know that in order to have a balanced market, we need more inventory. Zillow reports that the total number of homes for sale has continued to increase throughout the year, ticking up 4% just from May to June to stand nearly 23% above last year's low level, while inventory levels are still about 33% below pre-pandemic levels. That's the smallest deficit since the fall of 2020, when the pandemic housing boom started due to record low mortgage rates and the explosion of remote work, allowing people to buy homes in different areas with cheap money. As far as price cuts, Almost 1/4 of the listings, 24.5%, saw a price cut in June. That's the highest rate in roughly 6 years for this season, according to the Zillow report. Competition is easing fastest in the South. All major southern markets are either neutral or buyer-friendly, with the exception of Dallas and Raleigh, said Olson. The Zillow report also shows that home values are up year over year in 46 out of the 50 largest metro areas. Annual price gains are the highest in San Jose, up 12%, Hartford up 10.5%, San Diego up 9.4%, Providence up 7.7%, and Los Angeles up 7.6%. Home values are down year over year in 4 major metro areas. New Orleans down 6%, Austin down 4.6%, San Antonio down 2.7%, and Birmingham down 0.6%. Zillow also reports that the typical mortgage payment is up 6% from last year and has increased by 112.5% since pre-pandemic. However, according to Mortgage News Daily, mortgage rates have fallen a bit to 6.83% for the average 30-year fixed daily rate, giving some buyers more purchasing power. And Redfin reports that the daily average mortgage rate has fallen to its lowest level since February, after last week's cooler than expected inflation report, bringing home buyers a bit of relief. They give an example of a home buyer with a $3,000 monthly budget who can afford a $450,000 home with a 6.8% mortgage rate. That buyer has gained about $25,000 in purchasing power since rates hit a 5-month peak in April, when they could have bought a $425,000 home with a 7.5% rate. To look at affordability another way, the typical U.S. homebuyer's monthly mortgage payments was $2,722 during the 4 weeks ending July 14, $115 lower than April's all-time high. That's despite home prices sitting just about $100 shy of last week's record high. Capital Economics expects mortgage rates to keep falling, but not by enough to fully offset the effects of the mortgage rate lock-in. The research firm's economist Thomas Ryan wrote in an analysis published yesterday. Essentially, he doesn't see a wave of sellers crashing into the market, at least not in the near future. Nevertheless, home listings have crept up this year, and we expect that trend to continue given the degree of pent-up selling demand, he wrote. Rising supply will slowly erode seller power, with house price growth slowing to 3% in 2025 and 2.5% in 2026. But existing home sales are still depressed, and Capital Economics sees them remaining muted throughout the next 2 years. As Ryan puts it, it seems like the housing world is slowly moving towards balance. It's better, all things considered, but it isn't a reversal of the fastest deterioration in affordability housing has ever seen. As far as interest rates, Ryan sees mortgage rates falling to 6% in roughly 2 years from now. Chen Zhao, Redfin's economic research lead, believes mortgage rates will come down a bit, but not by much. Now that it's looking increasingly likely the Fed will cut interest rates by the end of the year, some house hunters believe mortgage rates will fall more and are waiting for that to happen before they buy, said Chen Zhao, Redfin's economic research lead. But they may be waiting in vain. It's unlikely mortgage rates will drop much lower in the next few months, as markets are already pricing in the expectation of a rate cut in September, followed by several more at the end of 2024 and into 2025. Lambert reminds us that while many homeowners' monthly mortgage payments may be shielded by spiked interest rates, their employment situations may not be. If the U.S. economy were to slip into a recession, the rate hiking cycle could come back to pinch some recent homebuyers with a lack of savings. In addition, the U.S. credit card borrowers with variable rates are suffering from spiked interest rates as credit card stress and delinquencies continue to rise. The bottom line is that inflation affects all of us, not just homebuyers. Every time I go to the grocery store, I am shocked by just how expensive it is, especially compared to just a few years ago. I'm sure you all feel the same. We are experiencing an affordability crisis, and something's got to give. My concern is if the Fed does lower rates, more sellers may come to the market, but so will buyers. I guess it depends on how low rates will go to free up that locked-in effect. I can tell you from my own experience that next year, or actually in about a month, I'm going to be an empty nester and have thought about downsizing. But there is no way I'm giving up my 2.8625% interest rate to then go buy something with a much higher rate. In fact, I think for me, I would have to have interest rates be below 5% to make a move. What about you guys? What do you guys think? It just doesn't make sense to me. money. Let's end with some data from Redfin's latest housing market update for the 4 weeks ending July 14th. The median sale price is up 4.4% year over year, just about $100 shy of last week's all-time high. Pending sales are down 5.6% year over year, the biggest decline in 8 months. Active listings, or the total number of homes for sale, are up 18.4% year over year, the smallest increase in 3 months. 39.1% of the homes sold in the first 2 weeks, down from 44% a year ago. 31.6% of the homes sold above the list price, down from 36% a year ago. 6.7% of the homes did have a price drop, up 1.8 points from a year ago, and the highest level on record. The months of supply is 3.6 months, up 0.7 points from a year ago. The next few months in real estate is going to be really interesting between the NAR settlement and the new rules, possible rate cuts in September, and of course, we've got the election coming up. So it's going to be really interesting. That being said, we're taking off in the next 10 days to Croatia for our summer trip. So I will not be posting a video in the next 10 days. Really excited. What are you guys doing? Do you have any summer trips planned? Comment below. I would love to hear. If you missed the video on the NAR settlement and what that means for buyers and sellers, definitely check that out next. Thanks for watching. Bye!